Hello and welcome to this live programme from Baillie Gifford, and we're talking today with James Dow. And James is Joint Manager of the Scottish American Investment Company, better known to many as the Saints Investment Trust. My name is Richard Lander of Citywire, and I'm going to be talking to James about how he runs the trust with his co-manager for about 25 minutes. We'll then be taking your questions, and you can submit these at any time via the Q&A box in Zoom, and we look forward to those questions. So welcome, James.
Hi, good to be here.
These are interesting times at the moment, and we're going to come back to that in a minute. But let's start with first things first. Many people watching today will know all about Saints. Quite a lot of them will be investors, but many others won't. So for the benefit of this latter group, can you just describe what the trust is about and what you're trying to do for investors?
Absolutely, yeah. Hello, everyone. Thanks very much for tuning in. So Saints has two core objectives, things that it's trying to do for its shareholders. First of those is a resilient income stream, an income stream that Saints shareholders can rely on through good times and bad, thick and thin, COVID, Russia, Ukraine, whatever. A resilient income stream, very big part of what we are trying to deliver. And then the second core objective is about growth ahead of inflation, both in income and capital over the long term. So those are the two big objectives: resilient income, above inflation growth. It really aims to serve two different types of investor, I would say. A big part of Saint's shareholder base is investors seeking that growing resilient income, folks in retirement, for example, sort of a core holding for them, we hope. But there's actually a second type of investor who Saints is also very well suited to, and we know a lot of them invest in the trust. And those are investors who would not actually call themselves income investors. They're not interested in Saints dividends per se. What they're looking for is a trust which can deliver them steady capital growth and steady total returns over a long period of time. What some people would call a quality growth, a core growth, or I prefer just say a dividend growth approach. So that group of investors, it's also very well suited to, as well as the income-seeking investor. And last thing I would say is, you might sort of say, well, hang on, why would somebody looking for quality or core growth and invest in an income strategy like Saints? And the answer is because Saints, it's important to be clear, Saints is not a traditional income strategy in the sense of being full of high yield companies like telecoms and banks and oils and so forth. It is very much a dividend growth strategy, which owns, if you look in the portfolio, you'll see names like Analog Devices or Atlas Copco or Kering or Apple even. So which in our view are very much better investments for the long-term income investor. So that's why it plays those dual roles, both for income growth investors, but also for the sort of steady growth investor as well.
Great, okay. But there is this emphasis on dividends, and to a certain extent, this sets you apart from the other traditional growth-oriented funds and investment trusts within Baillie Gifford. So how different is the investment philosophy that you adopt along with your co-manager as opposed to on these other growth funds?
It's different in some key respects, but also very, very similar in key respects as well. So the first difference is the type of growth that we look for on Saints. So as I said, that's very much about steady growth rather than exponential growth. We're looking for relentless sounding year in and year out. We're very happy if Saints stocks can grow their earnings and dividends by 8, 9, 10% a year and do that for a decade. That kind of compounding we think should outperform. But that's different from some of the other Baillie Gifford managed trusts, which are shooting for much higher growth rates. So that's one key difference. It's a different type of growth, a different rate of growth. And then, as you said, Richard, it's the dividend focus. So some of the other Baillie Gifford managed trusts, as you'll know, focus on early stage private companies, maybe currently unprofitable, those types of business. And, frankly, I think they've done a fantastic job of picking those over the long term. But Saints is much more about companies with more established business models, certainly profitable, not mature, not X growth, certainly not. We still see them growing very nicely for a long time to come, but they've moved out of that early stage and they're now typically generating surplus cash. They're paying out dividends to shareholders. So obviously that dividend focus is different as well. And that's why you get really quite a different profile of volatility from Saints than you do from some of the other BG funds. If you look at Saints share price or NAV growth over time, you're going to see much more steady growth, much less volatility. So that's what I'd say is different. Obviously the dividends, but then the rate of growth. What is absolutely the same, and is why we're part of the Bailey Gifford fold, is first of all, we're very much long term. So we are always talking about, yes, but what's 5 to 10 years out? We think that's a huge advantage over most other market participants who are often, looking at next 12 months, for example. So very much long term focused, very much bottom up, company by company. What are you actually getting? What are you actually investing in this particular company? That due diligence. And then we're global. We're big believers that the UK does not have a monopoly on fantastic dividend growth companies. There are about 5,000 dividend paying companies around the world, and by being global, as are the other BG trusts, that's a huge advantage to our investors.
Let's focus in again on dividends, and we've had 2 years of the pandemic, which we might or might not be over, who knows. But that was a huge shock, especially at the beginning, for many dividend-paying companies, and some of them recovered and some of them didn't. So what were the characteristics of those that came through the pandemic and satisfied the criteria for inclusion in Saints versus the others that proved unreliable friends?
Yes, and obviously something that we've given thought to, and to put it in context, Saints income in 2020 was down by, I think it was 3%, and the board raised the dividend. So we saw that resilience really come through in the portfolio versus, which I have to say was very pleasing, because we put a lot of emphasis on that, and we saw it come through in 2020. I think, sort of reflecting back on it, I think one of the things that made a really big difference, and I don't think anyone still is talking about, frankly, but to me, when I look at it, it makes a huge difference, is investing in companies with bright futures ahead of them. Companies where the management teams can say, well, look out in the next 5, 10 years. We're really optimistic and excited about our business. And I think one of the problems with a lot of the dividend cutters, so let's take the high street retail REITs, for example, the Hammersons of the world and so forth. I think coming into COVID, they knew they were over rented. They knew they were under structural threat from online sales, etc. And when the panic hit, when COVID hit, they said, look, the game's up. It's time for a dividend reset. And I think the vast majority of Saints holdings, because we're very much sort of future focused in the next 10 years and looking for companies on the right side of history, bright futures ahead of them, I think that's a really big reason why a lot of the managers of those companies said, look, we can still pay a dividend. We're still really optimistic about the future. We really don't need to cut or reset. Let's just keep paying. So I think that was a really big factor that made a difference that a lot of people haven't maybe talked about as much. You've then got your other sort of usual suspects of, whenever there is a downturn, whatever the cause of it is, the same problems always come to the fore again and again. If you've got a business, you're investing in a business with deeply cyclical cash flows, like automakers, for example. I mean, one of the reasons Saints doesn't invest in those is, by nature, they have deeply cyclical cash flows. If you have a recession, dividends will be cut. If you have a weak balance sheet versus a preponderance of cash, that another usual suspect, those who have too much debt going into any crisis will find they can't refinance, they can't roll the debt over, the dividend gets cut. So avoiding those and focusing on strong balance sheets. So that's another big piece, I think, of what is differentiated between the two, and why you've seen some companies, the best companies, strong balance sheets, they've been taking advantage post-COVID and have been acquiring troubled businesses that had too much debt in them. So a big thing there. Third thing I would point to would be, I think, wild cards around regulation. So a big thing that really has struck us, sort of analysing it, as the randomness, if you like, of regulation around dividends. So at one extreme, you've probably got examples like France, or the UK, where there's really quite heavy intervention by governments to say you should not be paying dividends. We forbid them. At the other extreme, you've got countries like China or the US, where if anything, dividend payments were encouraged. Support your shareholders through these difficult times. That kind of wild card around regulation, to us, is a great argument for global diversification. You never really know where that's going to come up. And I think that was a big factor in who cut their dividends versus who was able to maintain, and why Saints had a really quite benign experience.
Great. So, I mean, the other effect of the pandemic, of course, was not just changing people's dividend payment patterns, but changing the way we all work. We're doing this. We wouldn't have dreamt of doing it this way 3 years ago. How we work, how we travel, how we enjoy ourselves. So how does this manifest itself in the way that you're picking companies for Saints?
Well, let's start with what we know. Okay, so we can say with, I think, very high confidence that the world is going to be changed profoundly by COVID. If you look back at other big societal crunch points, if you want to call them that, from the 1930s, World War II, 70s labor disputes, whatever it is, you know that things aren't the same. I know we all say, "Oh, I just can't wait to get back to normal." I know I say it all the time, "I just can't wait to get back to normal." But kids go back to school, etc., etc. But we also know, I think, that the world isn't going to just go back to 2019. Things are going to change. I think what we don't know yet, and I would caution you against listening to anyone who is adamant that they do know what's going to be different in the future. We don't really know the details of exactly how that's going to work out. There'll be, with hindsight, we'll be able to say, "Oh, that, of course, that will catalyze that change," but it's difficult to predict that. So what does it mean for us as investors? What it means, I think, is really paying a lot of attention with the companies you invest in. Certainly what we're doing for Saints. Are they run by people who can adapt? Are they management teams who have a history of moving with a changing world? Or are they people who tend to be a bit accident prone and tend to get caught out? You want to be with the companies run by people, or structurally they're in a way that they can adapt to change. Because whatever is going to happen over the next 10 years, that's going to set you up in really good stead as a shareholder. So I'll give you an example. In fact, this morning I was on the phone with one of our holdings in China, a video gaming company out there. One of the leading sort of producers. The latest Harry Potter game around the world is actually all produced by this company. Okay, the past year they've had huge changes in regulation around video gaming in China. But the company's been around for a long time, and it's run by very thoughtful, adaptive people, and they've done a terrific job of navigating that sort of uncertain regulatory environment in the past year. And they've just increased the dividend by 49% year on year because they've done so well. So that type of company that can really adapt to changing times and work out the way to go forward, I think that is the best single focus in a sort of post-COVID world of what investors should focus on.
Right, because we see the headlines: China shuts down education companies, games companies, and we tend to think that's it. They're going to go bankrupt or stop their dividend. But
right, and we added to our position during that period because we said, well, for some, yeah, absolutely, but we're backing this company and we know them, and the reason that we did our due diligence on them for getting on for 10 years was to get to know them and make sure that this was the right company to invest in, and that's really come through, and they're in a fantastically strong position right now. So that can be an opportunity for you as an investor if you're backing those kind of adaptable, flexible companies.
Great. Now, ESG isn't in the trust name. It probably wasn't even dreamt of when Saints set up all those years ago. But how do you integrate ESG into your stock picking? What do you look for? Do you have any numerical selection processes, or is it all done qualitatively? And what companies do you exclude?
So let me start by taking a bit of a step back about why ESG matters to Saints. Matters a lot. And this is not just my view, this is our board's view. We're all fully aligned on this. Our view is that if a company is making a product or a service that is deeply harmful to the environment, or it's treating its employees badly, or it has really poor governance practices of some sort, those companies are, in our view, going to really struggle to grow their earnings and dividends the next 10 years. They're going to face regulation, employees will leave. They're basically at high risk of ending up like we've seen transpire in, let's say, coal mining or tobacco, would be another example. The companies that have really, really struggled to grow their earnings and dividends, they still exist. They don't necessarily go out of existence because they're still providing something which there is some demand for. But in terms of growth and providing you a good return as an investment, the odds are really quite stacked against you. You can see that if you look at those industries past 10 years, that's definitely what you'd find. Now, for Saint, obviously, as I said at the start, we want to deliver resilient income and growth over time, over the next 5, 10, 20 years. And it's really going to reduce the odds of Saints continuing to deliver that if we're investing in companies that are doing, quite harmful ESG things. So that's why, if you look at Saint's portfolio, if you look at the names in it, you won't, for example, see really big carbon emitters. Because our view is that if you're a long-term investor, you're looking at the next 10 years, those companies face some really serious challenges. They're going to most likely have to shut down some of their operations. They're going to have to try and reinvent themselves, where often they have no skills. The odds of them growing their earnings and dividends, they'll probably still be around, but that kind of growth and great returns from investment are much less likely. So it's something that we take into our analysis very seriously because it really impacts on Saint's objectives. And the way that we do that is we've developed something in-house. This is going back 4 or 5 years, I'd say. We've developed a framework, our own sort of bespoke one, which we call our Impact Ambition Trust Framework. So what that means is for any company that we look at for Saints, we'll put it through that and we'll ask, what is the impact of this company on environment, society, stakeholders, etc., products and operations? How negative is it? Is it negative? Is it positive? How ambitious are the people running it to improve and get better and adapt with time? And how much do we trust them? That a lot of companies have grand goals, look very ambitious, but if you actually look at what they're doing, they're not doing a great deal. So can we trust them to actually be delivering on those? So we have this framework that we've developed over time for Saints that every holding will go through to make sure that, if it's really harmful and the company has no ambition to change and we don't trust them anyway, it's probably not going to fit with Saints. If, on the other hand, it's, I like to point to our insurance broking business, AJ Gallagher in the US. Its impact is de minimis. It's some people sitting in offices. It's not a heavy carbon emitter, etc., etc. The ambition, the trust. If we feel that it scores really highly on those, and I would say this is, by the way, a qualitative assessment. I think we're all a bit skeptical of, I've put a number against it and the computer said no kind of thing. A qualitative, subjective assessment of these things, impact, ambition, trust, that's how we pick stocks that fit with Saints for the next 10 years.
Right. So you mentioned an insurance company, very traditional, but probably growing. We're all going to do insurance, for probably more of it, given the way that things are happening. But some other trends, perhaps some more interesting and future-looking trends that are driving your stock selection. Can you go through a couple of those and maybe a couple of company names?
Digitization in industry. As consumers, we've all got a phone in our hands and we've all been digitalized in a lot of ways, right? We're all consuming a lot of data. I think in some parts of industry that's happened a lot, but a lot of parts it hasn't. There's a lot of industrial processes which are still really quite crude and analog, paper-based even. So we think we're still in the early innings. Excuse me while I... Still very much in the early innings of that digitization of industry. So there I would point to a company like Analog Devices, which is in our portfolio. So to digitize things, you need a semiconductor within the analog space dealing with real world signals. there's really two companies that have emerged as global leaders, one of which is Analog Devices. So it's got this tremendous tailwind behind it, progressive dividend policy, great management team, long established, really great investment, we think, benefiting from that digitalization industry trend. Electrification would be a big second one that we spend a lot of time working on and looking at. The cost of producing electricity is for technological reasons is falling quite dramatically. Partly renewables, partly solar. And then if you look at the battery technology that's coming down the pipeline in the next few years and what that's going to mean for some of the issues around intermittency of supply for electricity, it's quite a positive case for electricity cost reductions through technology. And what that probably means, and I guess this is particularly topical now, is that if there's an opportunity to switch from oil and gas into something that you can put voltage into, that's going to be really appealing. One of the appeals of electric cars is if you fill it up, it's just a heck of a lot cheaper than going to the petrol station, right? So beneficiaries of that has been a big focus of us, continues to be a big focus for what we're doing. I'd point to Albemarle in the portfolio as a good example of that. So it's the leading lithium producer in the world. All of the batteries involved in this require lithium. Where's the lithium? Albemarle. Very hard to bring on new supply. So electrification, another big one. And then I'm just going to pick thirdly, I would say healthcare. Just generally, there's still so much innovation coming through in healthcare. There's still so much potential and unmet need. It's exciting times. So finding ways that we can benefit from that. I would point as a stock example to Sonic Healthcare in our portfolio. It's one of the biggest networks of testing labs, not just for COVID tests, but for any kind of test under the sun. That's one where I would argue, one of the things I think we do know post-pandemic is that probably there's going to be increased emphasis on testing and the value of testing and things in advance. Now, I know who isn't sick to death of being tested 22 ways, but I think the value in that has become apparent in various ways, and healthcare systems will use more of it, and that's a big beneficiary of that trend.
Right. So we can see what things are going to be like in 10 years. It's a pretty decent time period, and right now, we've just gone from the shock of the pandemic to the shock of inflation and monetary tightening, and then these awful events of the Russian invasion of Ukraine. I mean, what happened at Saints HQ when this happened? Did you sit down and say, we've got to think differently, or how do we get through this period, or do we just keep our eyes on the 10-year milepost all the way out and carry on regardless?
Yeah, with Russia and Ukraine. Well, first of all, Saints has no direct exposure to either Russia or Ukraine, so that's a helpful starting point for the impact on the portfolio and the earnings and the dividends. I think what it means and what we've been sort of saying is, the value of resilient businesses with established business models, in demand, good balance sheets. Our company should just be in an ever stronger position. They should be able to weather this and the volatility that it's causing. And obviously, we do a lot of diligence around the portfolio, and we'll continue to monitor that about how things might be impacted. And for sure, there will be some things that crop up in supply chains, whatever it is. It will come up somewhere. But I think principally what it's meant is, having done that check and satisfied ourselves that there is no direct exposure and we're well diversified and geographically, it's continuing that focus on resilient business models with good long-term growth prospects. That's the best answer from an investment perspective that we can find.
Things will be changing so quickly at the moment that we can't really deal with things on a day-to-day basis at the moment. You're changing the gearing environment for the company this year, and I think probably a lot of investors know, they've probably had to approve it, is to get cheaper gearing, which is great. Lower interest rates gives you more firepower. What are you going to do with that firepower?
Well, the plan remains the same. So it's the logic of the gearing within Saints is Saints can borrow very long term at really quite attractive rates, being quite a sort of established, well-known company with diversified asset base. And then we can invest that into a combination of property, bonds, and more recently infrastructure, and earn a yield higher than the cost of borrowing and pay out that extra income to Saints. And that also helps with that point around the steadiness or the volatility of it as well, because often those things are actually really quite secure income streams, lower risk, and so forth. So it fits quite nicely with Saints' core objectives. So the plan will be just to continue doing that for the years to come. What's changing is that the last several years, that strategy has worked less effectively because of the cost of borrowing. Saints had some of its borrowing, which was taken out in the 1990s and had a really high coupon on it, 8%. That matures in 1 month and 21 days, I believe.
Not that you're counting.
No, not that it's on my mind. And a couple of years ago, in fact, pre-pandemic, we, taking the longer term view, we said, let's go out and pre-finance this now so that we haven't got any refinancing risk when it matures in 2022. So some time ago, we pre-financed the rollover of that debt into with a new lender. The result is that Saints will, as of April, have about 95 million of debt with an average borrowing cost of just under 3%. That's obviously a big change from historically. And that strategy of, well, if we can borrow at less than 3 and we can invest greater than 3, and by the way, a lot of those assets actually deliver real capital growth with a nominal liability, that's going to look even more attractive. Now, the one thing I will say is don't expect any big change in the level of gearing, because the board and we are very focused on making sure that's prudent. It's a nice thing to be able to do, but we will never let it in any way jeopardize Saints or the dividend dependability or so forth by gearing up the trust. So typically the gearing is somewhere in the 10, 15, maybe as high as 20% range. But we do a lot of stress testing to make sure that the debt's never going to catch us out. So that will remain the case because, we're very conscious. Shareholders see value in Saints for that resilience of income stream, the steady growth over time. And, one of the reasons that we've been able to deliver the 48 consecutive years of dividend growth is that kind of prudence in, making sure that the companies we invest in and the borrowings are never going to catch anyone out. They're going to be a nice addition, but they're not going to pose great risk.
It's not going to be the tail that wags the dog, so.
Certainly not, no.
Good. Okay, let's go on to a few questions now, and we've got some come in, and one does relate. You mentioned their property and infrastructure, and I saw late last year you were talking about that. And the question is, what type of property and what type of infrastructure?
So the property is directly held alternative property in the UK. So we have actually a second manager specifically for that portfolio, and he has an incredible track record over the past, now 25 years. I think he's been working with Saints, and his expertise is seeking out what I'm calling alternative property. So what we're talking about here is not the kind of the big property funds all piling into London offices or anything like that, but unique individual properties. So, for example, the biggest asset in the portfolio has been historically a data center for a telecoms company. Now, that was actually sold last year at a huge premium, which is, if you've looked at the results, you'll see that the property portfolio had a particularly good year last year. But it's that kind of slightly off the beaten path, not the kind of mainstream property. That's what's in the property portfolio. And then the infrastructure, this is a smaller part of it, but we're looking at anything globally that really fits with that remit of good, resilient income and low risk capital growth as well. So I'll give you a nice example there that we've taken a small holding in the past 12 months. Is one of the electrical grids in Europe, Terna, where the regulator is saying, look, we want you to invest a lot more in connecting renewables to the grid. will allow you to make a good return on that. And the company is saying, as we do that, we will pay out that expanded grid, the cash flows, as a rising dividend. They're talking about a 6% inflation. So we've got a core, unique asset that's always in use, that should see capital and regulated asset-based growth over time, with a good yield that's growing about 6% a year. So it's that type of infrastructure that we're looking for as well.
Excellent. Another question says you talked in some depth about being a global trust, looking for dividends everywhere. Where do you see the biggest promise regionally for dividend growth?
The honest answer is it's so bottom up for us that they can come from anywhere. I think the company and its opportunity really trumps where it is, especially in a global world, because we know this from the UK market, right? There's a lot of UK companies, but actually most of the profits come from overseas, like an Experian or something like that. So I think that's the case everywhere. Now, so I don't want to duck the question and say, well, it's all bottom up. One area that we have been looking at more and more is China, because most people say China, oh my goodness, it's incredibly high risk and who knows what will happen, and so on and so forth. A lot of people will say that. But actually, if you look at founder-run, well-managed companies with bright growth futures who are really committed to dividends, possibly even more than some UK companies, and we saw that in COVID, where many of them raised their dividends to help support shareholders. That is a huge untapped market. Not a big part of Saint's portfolio, but there's a huge and growing opportunity there for dividend growth companies. You need to be careful that you pick the right companies, and that's what we spend a heck of a lot of time focused on. But as a region, that has an unusually big opportunity if you look forward 10 years.
Great. Question here about regulation, and you talked about companies that are, in the crosshairs of regulation. What type of companies and which regions do you think have the worst risk for interfering regulation?
So as a general observation, I would say that there are certain things which are kind of viewed as public goods or quasi-public goods. And those things tend to be really quite heavily regulated. People will say, oh, look, you can invest in this water utility with a 5% yield. But most people feel that water is a sort of, it's a basic right, and should it even be privatized? And you tend to have very heavy regulation around those types of goods, which means that your risk of someone coming in and saying, sorry, but you'll need to cut the dividend is elevated compared with under other industries. So those would be ones where sort of by their nature, you've always got quite a lot of risk around the regulation coming in. I would say the other big one is the sort of systemic risk pieces. So if you look at Saint's portfolio, one reason that we only have a couple of banks, quite small positions in the portfolio, is that banking is another one of those sectors where typically you've got a lot of regulatory oversight, let's say, and people will say, don't let the banks pay dividends. And some of the banks will say, but we have huge amounts of cash and there's no risk at all, but they will tend to have regulatory interference. So those would be the systemic risks and the public goods, I'd say, are those where, and that doesn't really change. That's kind of always the case. As a stock picker, you can find individual examples from time to time where you say, well, actually, right now, the regulatory environment is very favorable. That electrical grid I mentioned earlier. So I don't want to rule them out. And by and large, I'm not really a fan of excluding things, but you just need to be careful when you're stock picking among them.
Brilliant. A couple more questions before we wrap up. This one talks about your fixed interest, small part of the portfolio, and I don't know if this created a capital loss last year, apparently. Is this an area you seek to develop further?
A little bit, yes. So it's right. I'm delighted that someone's reading the annual results and accounts to notice that. And I would point out some of that is just foreign exchange movements in any given year. So one of the things that we'll invest in to a limited extent, is sovereign bonds overseas. And you get exchange rate movements year to year. Over a longer period of time, those tend to average out, but in any one given year, you will see a bit of volatility around it. Will we invest in it? It has a small place, because if you go back to that strategy with the debt, if you've got a nominal liability and you've got a nominal asset, but you're earning a higher yield, and actually you think that the risk is really mispriced and it's very low risk, as we do with the few things that are in Saints, then it can generate some extra income for shareholders. But it's not. But it also has its challenges. So it doesn't naturally fit in with the long-term growth objective. Bonds, they have been the past 10 years as rates have come down, bond prices have appreciated. We don't have that as a central view that the next 10 years that we're going to see that same appreciation. So they play a useful little role in Saints occasionally, but they will remain very much a minority part of the portfolio.
Final question, more about the way you work rather than what you're investing in.
Okay, yeah.
How have you dealt with stock picking during lockdown? And are you going to be back in the office full time, or is it going to be hybrid?
I am back in the office full time already and have been for some time. Yeah, it's funny. It depends on the individuals, I think. Obviously, first it depends on the rules, but it happens that the team around Saints, that there are a good number of us, as it turns out, we all like talking and being together, and the interaction and so forth that we think is really important for stock picking. And so, as the rules have allowed, we've been in pretty much as much as the rules have allowed. And I think that for our team, that will probably continue being the same, just because that's the way that we like to work. Totally understand that other people don't want to do that, or it doesn't make sense. I think that one of the interesting things I've seen is that it's opened up. Previously, for talking to our holdings and keeping in touch with them, I mentioned earlier the call this morning in China. The ability to just do Zooms and keep in touch with people is fantastic. It means that from a portfolio monitoring perspective, instead of getting on a plane and I have to fly to London and I have to transfer and blah, 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 and you're exhausted, those days are gone. We can keep in contact. So there's some huge benefits to all the communication stuff that have come through. But as a team, I think we'll continue just working in the office. That's the way that we like to do it, and we'll continue that same way.
And avoiding airline stocks as a result.
It's a bit of a tricky environment, and they're not. I wouldn't say they're naturally stable dividend payers. So
good ways to destroy capital. James, it's been absolutely fascinating to talk to you. Thank you very much and for your insights and the time you've given us today. We've had more than 200 people join us today, so thank you all for watching and thank you for your questions. Please come back. We've got more sessions like this coming up with Baillie Gifford, so do keep an eye out for those if you found today useful. And thank you very much.